Hi, everyone. All right. Our next talk delves into the issues of unequal financial access. In a landscape where the cost of borrowing money continues to soar and obtaining credit approval is increasingly challenging, this fireside chat will unveil straightforward policy adjustments that can pave the way for fair and equitable opportunities. Please welcome founder and CEO of Koho, Daniel Eberhard, and Senator Colin Deacon.
Let's do it.
Here we are.
It's great.
Over to you, boss.
Are you introducing this?
I think you should.
Okay.
Smart guy.
Allegedly. Everybody, my name is Daniel. I'm the CEO and founder of a company called Koho. What we do is we give everybody we're what's called the Challenger Bank. We give everybody a core account. We have given ways to make it easier for folks to build and improve their credit history, borrow cheaply, a higher interest rate. I'm very lucky to be joined by Senator Deacon here, who is one of the leading voices and the champions for a lot of the things we're going to talk about today, which is financial inequality, the systemic stability of Canada, and some of the incentive structure that makes it challenging for Canada to stay competitive over the long term. So,
And I'm just really glad to be here again. I was honored to be invited. Last year we had a great conversation about how open banking and financial technology companies can really help marginalized Canadians in a significant way. And I think that's really going to be the focus in many ways about what we're talking about still today, because nobody has pushed the button to say, hey, let's go with open banking. And there's one person that needs to, but we'll talk about that more.
So as we talk about this today, we're going to try and play at multiple altitudes. And so what I want to show you folks today is some data on what's happened from a policy level in Canada, some data on what happened at a consumer level in Canada, and also some data on our own experience trying to build a challenger, quote unquote, bank in this country. But it's important that we actually ground this in what this means. And I think one of the core beliefs that we have at Koho is financial stability is a precursor to agency. And what I mean by that is whatever a fulfilled life is for you, going back to school, putting your kids through school, a second job, however that shows up, it is very difficult if you don't have financial stability. And the argument is that big chunks of financial stability are being eroded kind of unnecessarily in this country. And so we'll start with this chart right here. There we go. This is a pretty nerdy chart, but this is what's called a learner index, and it's an economic metric of how efficient is your banking country, is your banking climate. And so what this does is it looks at like supply and demand dynamics and determines whether there is changes in pricing and how much revenue and margin the banks are making. And so you can look at this, and Canada versus the G7. Now, 0.1 to 0.2 is a healthy banking climate, and anything above 0.4 is very, very rare and not competitive at all. The only country that I've seen with a higher learner index than Canada is Qatar. And so I think the question that this chart prompts is, what happened in 2009, and did anybody opt into one of the least competitive banking climates in the world? And so when we look at this, we should think about, what does that mean for everyday Canadians? What does that mean for the 50% of folks who are living paycheck to paycheck, or the 80% of Canadians who feel like their financial position has got worse year on year? And one of the myths in this space, and Koho is very focused on the paycheck to paycheck audience, is 30% of folks who are making $150,000 a year living paycheck to paycheck. And so this is not just a lower socioeconomic challenge. This is an everything challenge. And I think what we're saying is, this doesn't show up on any balance sheet or any constituency chart or any P&L anywhere, and that we do a bad job of sharing this math with folks.
And what I find concerning is quite often the thought of bringing more competition through financial technology into the banking system will represent a prudential risk. It'll put the stability of our banks at risk. And those are completely separate issues. How we regulate our banks, and we should be very proud of many ways in which we regulate our banks. I think we can get a lot better at it than we are. We shouldn't be resting in any laurels. But how we regulate our banks is very separate than challenging our banks to deliver more increasing numbers of customer-centric services. And that's what financial technology companies do. And the more protected you are as an industry, the less customer-centric you become. You will become organizational-centric. You do what's good for your business and for your shareholders, which is, that's a job of a board of directors. But what we've got to do is we've got to force that board of directors to get more innovative, more aggressive in how they serve customer needs. The best way to do it is bring some competition in along the lines of financial technology companies who offer customers things that are completely different than what the traditional banking system has been offering.
And just to pile on that, here's one of the myths that we have in Ottawa and frankly in Canada overall is like our banks in our country has done a great job of managing systemic risk. If you go and talk to a bunch of folks in Ottawa, they will say, we have done that at the expense of competition. And the truth is, if you look at every World Bank study on competition, you need competition for systemic stability. And it's particularly on the long term. So the argument that I would make is no matter what side of the table you're on, banks, public-facing, a consumer, Canada will not be competitive in 20 years if we don't start to figure this stuff out. Anecdotally, I had a conversation with a fintech yesterday who's providing brokerage accounts, and they launched 4 years ago as a company. They have tried to come in Canada since 3 years ago. They have launched in 100 countries, and they are still not live in Canada. And so what does that mean for the competitiveness that consumers have, the choice that consumers have, the cost advantages that consumers have? It is something that I think that no matter what, again, side of the table you're on, the long-term view of this is that we kind of have to start to figure some of this stuff out.
Hear, hear.
You want to talk lending? Here's an interesting one that this is Koho data. And so for those that aren't familiar, your credit score is a big determinant of what your loss rates are and therefore what the cost is to borrow as a Canadian. And so this is Koho's data. And one of the real challenges, there's almost this bifurcating event in Canada where if you have a 700 credit score, you can go get a mortgage at a good rate, you can go get a credit card, all those kinds of things. Now, the track to build your credit card or your credit history in this country is usually credit card debt, which means you're taking on unsecured debt at 20 to 25%, maybe an auto loan, and maybe a mortgage. Now, mortgages are increasingly not affordable, and so fewer and fewer people are able to build their credit score in traditional ways or certainly in safe ways. And so this is Koho's lending data. We've lent out hundreds of millions of dollars at this point, and you can see that even folks that are in kind of subprime and near prime sectors, we are lending dollars to these folks at the same loss rates as prime borrowers, as 700 plus borrowers. And so what this suggests is that you can actually innovate on underwriting. You can actually give folks an alternative to borrowing that isn't somewhere between you get a prime rate at the bank or payday lending. And so, this I think objectively says and is supported with the data that there is opportunities to innovate and to make cost of borrowing cheaper. And I could have a chart like this for almost every financial vertical, whether it's how folks invest or bank fees or $50 NSFs, you name it.
And I was on a panel, I'm pretty sure it was July, it might have been August 2020, where the Philadelphia Fed released data that's very similar to these. And they'd done a study looking at fintech lenders over, I think, a 15-year period. And when they started, there was a big divergence between traditional credit scores and who they lent to. There's great similarity with the credit score person they lend to and traditional banks. But over that period of time, there's a huge divergence that occurred. They could lend to individuals who were seen to be high-risk borrowers, but in fact were, in the term of the Philadelphia Fed, invisible prime borrowers. They didn't show up in the current credit score system as someone who was a trustworthy person to whom you could lend. And as somebody who had, just because I changed credit cards, my credit score dropped 50 points one month to the next. And if I had been getting a mortgage after that had occurred, I would have been paying a higher rate on my mortgage over the next 5 years because I changed credit cards. And I'm fortunate that I don't carry a balance on my credit cards. So how on earth is that something that should affect my credit score? So we've got a huge problem right now that a whole segment of our population is paying a lot more for debt, being driven to riskier and riskier debt options because our credit score system, in my mind, is not defensible in terms of identifying what the real risk is. That we don't analyze cash flow, we don't analyze a whole lot of things. I look at Koho's, some of the things that Koho and Borrowell and others have been doing to give people new tools to build their credit score, not expensive bank tools. I mean, that's something you speak to quite regularly.
Senator, like, you know, you have a pulse of what's happening in Ottawa, and give us, the audience, a sense of what those conversations are like in Ottawa. Are they happening? Do people care? Do people understand it?
There's broad understanding of the value of moving towards open banking and what financial technology companies can do. There's a broad understanding that we need to give consumers control over their financial data, over their data overall. And you know, data portability is going to be something that I think comes out of Bill C-27, which is finally really starting to make some progress. It's taken a year and a half almost, but it's starting to make progress. It's at least in committee in the House of Commons. But the problem is it stops in the finance minister's office. Now, she was here last night, I believe, at Elevate. Anybody hear an announcement? I was hoping maybe, you know, the button got pushed and we've got a plan on open banking that was, you know, one of the best consultation processes I've ever seen in Ottawa in my 5.5 years there. There was the open banking consultation processes at each step. Very inclusive, very robust. There's a plan that exists that Abraham Tastian has led the creation of. The major risk factors have been managed. We just need the finance minister to press go. And I can't get an answer as to why that's not happening.
So I'm going to call some shots here. I think there's a few challenges with this. One, I think that it is, so I am more skeptical on this. We've been talking about open banking for almost a decade now.
Well, you've got a bit more in the line on this issue than I do, and
Sure.
I'm frustrated.
Yeah.
I can't imagine how you are.
Exactly. And so I'm a little bit more skeptical. You know, I think that there's a few things that are at fault here. One, I don't think we as a fintech community and folks like Senator Deacon have done a great job of creating a unified voice for the downstream implications of all these policy decisions. I also think that does not make sense that we have a deputy prime minister who is also the chair of the department, or the head of the Department of Finance. I think that those are two distinct jobs, and we need somebody full-time in this role who's thinking about the long-term systemic stability. I think Deputy Minister Freeland is wonderful, but I think it's very difficult and very busy to do two jobs at once, let alone two jobs of this import. And then, look, I think the third thing is we have a CBA, the Canadian Bankers Association, which is just is a lobbyist group that I think holds a lot of power in this country. And I think they are organized and consistent and persistent in telling a one-sided portion of the story here.
So I'd say it all similarly but differently.
Okay.
And the way I look at it is I have not heard a single reason against open banking that is a defensible reason in Ottawa. And so I am really proud of the work that's been done to make sure we have a good framework, that this can be done responsibly. I don't want our banking system to be put at risk. I do want to see our banks being forced to become more customer-centric, not through regulation, but through competition. I mean, it's so much more efficient. It creates so much more opportunity. And no one has given me a reason why it's not happening. So I encourage you to write to your MPs and say, find out, tell me why. If you believe that this is something that's important, ask your MPs to tell you why this isn't happening. Get an answer from the finance minister, because to me, inaction is indefensible.
I'll tell folks another story here. Oh, did we lose our table? Oh, there it is. This is another kind of Koho-centric view of the world, but I think it's a relevant anecdote. So, what you're looking at. We launched in 2017 with this business. We have 1 million accounts. We power a bunch of businesses like Wealthsimple on their cash card and a few others. You know, we're doing almost $10 billion a year in transactions on our business alone. We are 5 or 6 years into launch, and we are still have a payment engine, which historically failed 20% of the time when users would first add funds, and is now kind of hovering around 2 to 4%. That is a broken payment engine by every metric. If you compare that to a country like, or to a Revolut's experience in Europe or some of these other challenger banks, Revolut went from inception to full bank license within 8 months. I'm not making excuses. They're a wonderful business. They've gone on to build a $33 billion business and have massively changed how financial services are consumed in a bunch of countries. And here and Revolut, by the way, came to Canada and pulled out because they couldn't figure out how to get their payments engine working here. And so I think that it's a bit of I don't know if folks are familiar with David Foster Wallace's wonderful talk called This is Water, but I think this is a bit of a This is Water moment where if you're a fish, you don't really understand what water is. And I think that we are swimming in one of the least competitive banking climates in the world. And I don't think that we always price that in. I don't think that we always price in the costs and the wash through of how that impacts people on every economic.
And my concern is we're at a point in time where there's a real cost of living crisis in this country. And cost of living is the biggest concern in Canadians' lives at this point in time. And every Canadian is paying a tax to the banks to maintain an anti-competitive environment. I don't want to see us bring in American banks to compete with our Canadian banks. I don't want us to enable a whole plethora of banks that are unregulated or poorly regulated. That's not what I'm saying. What I'm saying is that we need to make sure that we have a disruptive effect of some form. And right now we've got companies in this country that are able to provide services that go right at the cost of living problem for a lot of Canadians, and it doesn't cost the government a nickel. It's there, it can be implemented right away, the effects can be felt right away. I just don't understand it. And our time went.
There we go, right on time.
Thanks, everybody.
Thanks, everybody. That was fun.